get in a corporate voice as well, talk a little bit about the business outlook and PE's divesting part stake in five-star business and whether or not a further sale is on the cards. Lakshmipathy Deenadayalan is the Chairman Managing Director, now joining us on the show. Good to have you on board. Thanks so much for taking time out and joining in. Now, let's just get to the crux of the matter, because despite being a very fundamentally strong business and seeing pretty steady performance, since the month of August, we've seen the stock under a bit of pressure, with several notable PE investors divesting their stake on Friday. I just want to understand how exactly we should be reading into this.
First of all, thank you for having me in your channel. So let me use some good time to explain about this background. To start with, I'm talking from a traditional NBFC point of view, not the startup lenders. Let me split the traditional lenders into two buckets. The first bucket are the older ones, which they have come on the back of the parental support, where the parents would have been in a different business and they wanted to get into lending space. That is one set of people. Another set of people like Five Star, we don't have any parental support. It's a standalone lending lender where we have to take two challenges when we start getting into the lending space. One is the business model. The business model where you want to enter. You can't do what the bigger traditional NBFCs are doing. You have to do something different and niche for yourself and find your foot that you are a perfect lender to this type of segment. That was the first challenge for Five Star, which we did very well. First 10 years we learned. The next 10 years we grew very stronger. Coming to the second point, the growth capital. Since we didn't have any parental support, the growth capital has to come from the private equity space. From 2014 onwards, we started to invite private equities who understood this business model, has had confidence on us. So that's where the names what you are going to refer, they started investing in Five Star from 2014 onwards. The first challenge, the business model challenge, was well scripted. And if you see, just we are completing the 1 year of our existence in this as a listed entity. Our business model was taken up very clearly with the public investors as days goes, as months goes. Coming to the second point, yes, the private equity people who have come in have to liquidate at one time. We have to do it. But the good part is this, even in this part, Five Star has taken up in a very coordinated approach. If you see, pre-IPO, we had 70% of the capital from this private equity people. After the many block deals, what we have done, they have now dropped down to 38%. From 70% to 38% in a year, it's not an easy one. It's a well-planned, well-coordinated effort. What the bankers, the selling shareholders, and the company, they keep doing in last 4 quarters. So the first challenge of business has been taken care very well, and the second challenge of the new traditional NBFCs like us has to take up is how are you going to liquidate the private equity players without affecting the valuation or the price of your stock. I think Five Star has balanced it very well. And what I'm hearing from my private equity people and the bankers are, I think the liquidity is done. For next 4 to 5 months, you will not see any liquidity coming to the market in Five Star.
Lakshmi, we are focusing on who sold, but who's bought into when these large investors are selling? I'm just curious because we get the bulk deal data, but it's not very clear that who were the buyers. For a seller, there is a buyer, and for a buyer, there is a seller. So let's talk about the buyers.
I think all big names, perfect names who are going to be with us for next 5 to 7 years, the capitals of this world, the GSAMs of this world, Fidelities of this world, and mutual funds, HDFC mutual fund. I think all very marquee names they have got into in Five Star cap table in last 6 to 8 months. These are some big names, and particularly to be made to name more. We have White Oak, who backed us even in the IPO, were still backing us in the first block and even the second block.
Draw your attention to what we've heard from Reserve Bank of India in terms of unsecured loan. The category in which you are right now lending, some would also argue that it's largely an unsecured category also, because 1 lakh loan, 2 lakh loan, 3 lakh loan. While you may not classify them as unsecured, but it's very difficult to recover from there, because there's cost of recovery which would be difficult. So is this one category which Reserve Bank of India has flagged off, which they're calling unsecured loan, is something you also need to be worried about?
Absolutely no, Nikunj. First, let me go stage by stage. The RBI's worry from the media's report and the governor's speech is predominantly into non-traditional lending space, and that too into unsecured. Let me categorize it very, very well. Non-traditional lending space and unsecured loans. Whereas in Five-Star, we lend to the business category, the MSMEs of this country, and housing end users of the middle and lower middle class, of the shopkeepers and the self-employed of this country. So very, very clear, this is not a new lending space and unsecured, we don't lend to unsecured loans. So I clearly deny what you say. In last 20 years, we have seen many cycles, and this can't be a unliquidity done assets. We are able to liquidate assets. Both customers as well as company were able to do it. That's why you see the credit cost or the credit loss. It's at the industry best levels. So I don't think RBI will have no issues on lenders like Five-Star, who lend to the financial inclusion of this country at 3 lakh average ticket size.
Okay, so to understand the RBI communication, I'm repeating myself. What you are saying is that the impact on your lending and your customer profile is not going to be there, to put it very simple.
Yes, absolutely. Two things. We are lending for setting up a business. This is a long-term lending. This is not a short-term lending. This is not a working capital lending. We lend to a business guy who wants to set up his shop, or who has borrowed from moneylender to set up his shop to repay the moneylender's debt. And we are lending it for a long period, around 7 years, and it's fully backed by collateral. That too, a collateral where the entire family members live in. So 95% of my collaterals are self-occupied residential property, and 5% is a collateral which can be a shop or a vacant land. So 100% secured loan given to a business community which has a long track record even during COVID times. I don't think RBI is worried about this. My guess is RBI is worried about short-term loans, unsecured loans, Jaldi loans, QR code loans. I think these are the points where RBI is more worried about.
Your exposure to unsecured loan as percentage of your total book?
Zero.
Zero. Okay, and you have no plans to make it grow that book, because now others will be slowing down, so there's an opportunity for you.
Never, Nikunj. In last 20 years, when I joined Five-Star, my focus was only on a secured book, because I have read the Indian mindset very well. It is not, the lending underwriting is not for the good times. The underwriting should be for the bad times. So as far as the bad times concerned, if you are not backed by a emotionally strong asset, you will keep losing your capital.
All right, good to have you on board. Thank you so much for taking time out and joining in and giving us a lot more clarity on all of that news with respect to PE's selling stakes. 740, that's where the stock is at.